All right, so this is going to go through the homework problems that I've pulled up for Module 5. Yours may look a little different. It's really more to show the thought process on these. So this first one is looking at payback. And so keep in mind, payback is looking at a number of years, right? So we're saying this project would pay back its investment in 5 years or in 10 years. Payback ignores the time value of money. So we are saying that a dollar I receive in 5 years is just as good as a dollar I receive this year. So we know under our time value money calculations, that's not true. But payback is what they call the back of the envelope math, right? This is something you can just do real quick when you're trying to figure out how long would it take for me to get my money back. And sometimes that's an important consideration. Uh, if you have a company that's worried about cash flows and they don't want to get tied up into long-term projects, using something like payback will help keep projects shorter. In this particular case, we have to recover the $5,600 of that cash flow, right? And so they'll pay 1650 or receive back, the 1650 the first year, 2,900 the second year, right? So now we're at 4,500. And so there's only 1,000 left to go in that third year, 1,050. And so we know that by the end of the third year, it would be 1,450. So we just take the 1,050 divided by 1,450 and get 0.72 years. So we get the first 2 full years plus 0.72 years more. So the average accounting return, this is just another way of trying to calculate what is the return of a project, but using the fact that when we account for some items, the book value and the actual market value could be different, right? So this is one that's focused on using the book values, right? The advantages of that is the book values are all agreed to, right? Those are audited financial statements, things like that. And so I'm not saying that there's actually a lot of value to this thing, which on paper doesn't have that value, right? So just it works through the same type of calculation we would normally do, right? If we're going to average our net income, you would just take the net income of the 4 years, divide by 4, that's your average. The book value, we have this initial purchase of 17, or it's an installation. It's not equipment. I'm sorry. It's a whole plant, but the installation is $17.8 million, right? And it's going to over time go down to zero, right? So the average book value is half of that, right? So 8,900,000. And so net income divided by the book value. And in this case, it's average net income and average book value. And so we're saying the average accounting return is about 20%, right? We're not going to do this nearly as much. We tend to focus on market values, market rates. But this can, again, sort of the type of calculation that's easier to do sort of when you're in a meeting, talking to people, and sometimes this can be a good way of showing some things. This next one is going to be a little busy, and I know there's a lot there, so let's just focus on the problem first. It says, considering the following cash flows, we're going to have to pay 32,500, and then we're going to receive 13,300, 18,400, and $10,700 over the next 3 years. And they're asking us to calculate the net present value at a 0% rate, 11%, 21%, and 31%. And we know the higher and higher this discount rate, the lower the net present value will be, right? Because those future cash flows will be worth less and less money. Okay, so if you see in the middle at the bottom that image, this is to show a BA2 plus calculator. The white row is the time value of money. We've been doing that row. So on this one, we're going to focus on the two or the three buttons above that in the middle. CF is the cash flow register. So this is where we're going to put in our cash flows. NPV, right, net present value, and then the IRR is the internal rate of return. So we're going to use NPV and IRR a bit in this. And then you see that compute button is highlighted. So we're going to have to use that compute button as we scroll through those as well. But when you hit CF, the first thing you're going to see is CF0. This is the cash flow at time zero, right? And so in that case, if you look in the right-hand side, you'll see those negative 32,500. You'll just put in 32500 negative, and then enter that. So next to compute, you see the enter button. So you'll just enter that value, and then it'll say C01. That is the first cash flow. So you would put in what that cash flow is. F01 is the frequency of that cash flow. It happens one time for that 1 year, right? Then you get a second cash flow, and that frequency is for that 1 year. And then a third cash flow, the frequency is that 1 year. Now, when you hit the NPV, the first thing it's going to ask you is the I equals, what is the interest rate that we're discounting at? So if you put 0, what you're going to do is actually just add all those numbers up, right? So if you say negative 32,500 plus 13,300 plus 18,400 plus 10,700, you would get that 9,900. If there is no time value of money, that's why the payback works the way it does, right? There is no time value of money. We're just using an interest rate of 0, kind of thing. So this is the maximum value, and as interest rates go up, it will get lower and lower, right? So in this case, you notice 11% interest rate, the net present value goes from 9,900 to 2,200. And then at the higher interest rates, they actually go negative. A negative NPV means you should not do that project, right? It's going to lose value for the firm. Okay. Do one with IRR, right? The numbers are a little bit different, right? So just pay attention to that, I guess, when you look at this. But so we're going to put in new numbers in the cash flow. But you see again, C01 is that first year, and it's only for 1 year, and the second year and only for 1 year. And then we can compute the IRR. The IRR is where the NPV of the project equals 0, right? So if our discount rate is 16.5% or 16.58% or lower, then that project makes money. If it is anything above that, like the 21%, 31% we looked at before, those rates, in that case, you're going to get a negative NPV, and you shouldn't do that. Okay, and again, it uses that IRR right there next to the cash flow and NPV. Okay, profitability index is a little bit different. What we do is, instead of doing our cash flows with our initial payment, we calculate the net present value of all of the future cash flows, right? So we'll put it in the same way, but without that CF0, the initial cost. And instead, we take the present value of those future cash flows, and then just divide it by what our investment would be. And then that's the profitability index. So I'm going to invest between 9,600 and receive back, say, 32,900. Then that profitability index is 1.12, which is what I want, right? It's going to get me, 1.112 times my cost. Right, so I'd want a profitability index above 1. But again, we just put in the first year 1 frequency, second year 1 frequency, third year 1 frequency, and then just use the different interest rates to calculate those net present values, and then based on that, calculate the profitability index. Okay, so those have all been looking at one project in particular. We also have some problems looking at projects where I have to choose between the two of them, right? So we have 2 different cash flows here. One, we pay a bit more to start it, and then we receive the money back, in years 1, 2, and 3. The other one costs a little bit less. And if you notice, the pattern of the cash flows are a bit different, right? So if the required return is 13%, what's the profitability index? And then which one should you take based on that? And then if the return is 13%, what's the NPV? And then which project should you do for that, right? So this is the first half looking at just part A, right? And so we put in both of those cash flows. Again, the CF0, we're not putting anything there, right? The profitability index, we don't do that, right? Once we calculate the NPV of the cash flows, we then divide it by that initial cost. Now, one of them costs 90,000, the other one costs 58,000. So we'll just have to make sure we divide by the right number. And then we'll want the one with the highest profitability ratio. So we're going to pick project 2. Okay. Doing the NPV approach, right, where we also have that NPV of this present cash flow, putting that in, you'll see that actually cash flow 1 has a higher NPV, right? And so this is largely in part of like how much money did you have to put in, right? I could have 2 projects that both have the NPV of say $10,000, but maybe one of them cost me $10,000 and the other one cost me $50,000, right? And so it just depends on what is the selection criteria that you have at your firm when you're trying to pick between projects. And sometimes you will do multiple evaluations just to see what makes one project look better than the other. And we'll get into some other scenario stuff in just a minute. This is the same type of project selection, only in this one they give us payback, NPV, IRR, profitability index, right? So we're doing 4 different tests. The payback period, I'm not showing it on here because you saw that first problem. So you would just for cash flow A say, okay, I'm putting $428,000. How long is it going to take me to get that back? And it's years 1, 2, and 3 are not enough, right? In that last year, you get a lot of money back. And so you can see how that works out. And then the second one, 2 years doesn't quite pay it off, but in between the second and third, it does. You would just divide the remainder by that 20,100 to see how much. So don't show that on here, but that's I think rather straightforward. As far as calculating NPV and IRR, and then the profitability index for cash flow A and B, right? You see that we would just put that in the calculator as you see. Again, for the profitability index, you do not put cash flow 0, right? That's going to be a 0. And then we're going to divide by that because it's going to have us weigh things also by the amount of capital that we had to invest to even start this project, right? And then based on those, which ones would you choose? And you I guess you can argue either way, which one, but that's really you're just looking at how long does it take for either project. Which one has a higher NPV, which one has a better IRR, which one has a better profitability, and you just decide which one. Okay, and here's one using just IRR. And so you have these 2 projects, right? If you notice, they both cost the same amount, but their cash flows are different, right? In project 1, you get the cash back a lot quicker, or project I, sorry. And then project J, you get the cash back a lot more in years 3 and 4, right? So what interest rate are you indifferent? What you actually do is subtract J from I, right? So at times 0, those are both the same. And so it would be cash flow is 0, right? But in year 1, you'd say 114,300 minus 89,200, and that would leave us with 25,100. And the frequency will be 1 because we're looking at 1 year for years 1 through 4, right? So you just put those differences in. Initially it's positive, then it switches to negative, right? And then computing the IRR, right, we get the 17.22%. So at that interest rate, they both have the same net present value. Okay. So what that means, if the interest rates are lower or higher, we're going to prefer one of the projects over the other, right? This is the crossover point. Okay. So at lower interest rates, right, then you don't really care how long it takes to get your money. So the fact that it's further out, right, makes it not matter as much. So at low interest rates, you're going to like Project J because the $100,000 in 4 years is fine, you know. But as interest rates get higher and higher, the fact that Project I pays you so much in year one and then a good bit in year two, right? You're going to be so much more sensitive for interest rates. So as interest rates go higher and higher, Project I looks better and better, right? So if it's above the 17%, you're always going to do I. If you knew it was going to be less than that, you would take J. This one, what we're doing is looking at these cash flows, right? In year zero, we're going to make the initial investment, and then we receive these cash flows in years 1 through 4. They tell us that the required rate of return is 11%, right? And so what is the NPV of this project? We would just put in, again, those cash flows. If you notice, it says this company has all cash flows are blocked and must be reinvested for 1 year. And so in year one, we don't receive that money, but in year two, we receive that money, but growing at 7%. So you just multiply by 1.07. And then the same thing for all of the other cash flows. So you do receive the money, but you receive it a year late and it's only growing at 7% where our required return is 11. That's not a position we want to be in, right? But that's how this government operates. So we'll just put those cash flows in, use our interest rate of 11% and compute net present value and IRR. Again, net present value is negative. If IRR was equal to 11%, then we know the NPV would have been 0, right? The IRR is less than that, though. It's only 10.8. So since the required return is higher than the internal rate of return, the NPV is necessarily negative. Okay, so this one we're looking at a project that a company is going to take on, and one of the wrinkles in this one is you have a lot of things that are told to you that you don't need, right? And so there's this concept of sunk cost. So once you've already paid for something, maybe it was a team to go out and do some market research or something like that. Once you've paid for that, you've paid for it, right? There is no, this is part of doing the project. No, it's already been paid for. Whether you do the project or not, it's already paid for. And so you just ignore that, right? All we're looking at is, do I pay the money to do this new thing or not, right? And so if I use the land that I don't get to sell it, right? So I have to account for that. I also have to pay out to make this change, right? The plant is $21.3 million, right? And then I'm going to have to do some grading of that land, right? Because it's been sitting there, I'm sure. So we have to come in and have some earth movers, and that's 880,000. And so you'll just add those three things together, and that's your cash flow. So you're not dealing with you buying the land years ago because you already had it. You could just sell the land and collect 10 million, right? But you're not going to do that. And since you're not going to get the 10 million, that's going to show up as your cash flow initially. So I hope that makes sense, right? But yeah, so that's sunk cost. This is one where we're going to calculate net sales. And we're going to go through a bunch of these where we're going to talk about where some of the numbers come from. So we were doing the cash flow calculator, and we were taking like cash flow 0, and then C01 with a frequency, C02 with a frequency, but we didn't really say a lot about where those numbers came from, right? And so that's what we're going to be doing with this. So we're going to sell these motorhomes. The regular ones cost this amount, the luxury ones cost that amount. We're going to add another line If we sell those, you know, then we're going to have that increase in money coming in. But the mere fact that we're introducing new things, right? Then it's going to boost the sale of other things, right? If I'm just advertising the new McRib at McDonald's, you may decide you want a cheeseburger, right? It doesn't actually improve the sales of the thing I'm advertising, but it made you think of my store and you came in to eat anyway, right? And so you can get these other increased sales. And so that's what we're looking at here, right? And so we're going to have some increases, right, based on that. But also when I introduce a new product, I can have what's called cannibalization of sales. So some of the stuff that I would have been selling, those folks are going to switch over to this other one, right? And so we're going to have some losses in sales too. And so the net sales is going to be, you know, this combination, the brand new thing I'm doing, plus increases in sales of old stuff that I was already doing, minus the cannibalization of the old sales that I would have been able to get, right? And that's going to come up with net sales. I know it's pretty long-winded conversation, but I hope that made sense what's going on here. If I increase advertising, it's just going to change a lot of numbers. This is one for depreciation. So most of our problems have been straight line depreciation, right? But in accounting, we also have makers table, and this allows for accelerated depreciation. So instead of writing off, you know, 1/4 of it every year over 4 years, you write off more of it early on and less of it later on. And from a tax perspective, that's really nice, right? Because you want your money as soon as possible, right? And for the government, they've balanced those needs with what the government wants to do as far as taxation. And they've come up with these tables. So in this particular case, we have $7.2 million of an asset. We're planning on it being depreciated, and then we are going to sell it for $1.6 million. Okay. They tell us we're going to use the 5-year table, right? And so when we're trying to figure out how much we depreciated, it would be 20% the first year, 32% the second, 19.2 the third, right? So you just take the first 4 years, add up those percentages, multiply it, right, by the total value of the asset, and subtract that from the total value of the asset, and that'll tell you the remaining book value. Okay, and then we add our salvage value, right? But we have to pay taxes on the part that we've depreciated when we did this, right? So we're going to salvage, but we have to pay taxes. So that's the after-tax salvage value. Okay. And we're also going to look at operational cash flow. So when we're talking about where do those cash flows come from? So operational cash flow is trying to remove out everything that has to do with financing, right? And then anything that we did that was purely for tax consideration. Okay. So what we end up doing is this is using the tax shield approach. There's multiple ways in the book of calculating operating cash flow, but mathematically they're the same, right? It's just like algebraically they're a bit different based on some of the information you have available. But in this one, they told us, you know, how depreciation worked. It was that straight line. They tell us what the annual sales are going to be. They tell us what the costs are going to be. They tell us our tax rate, right? So, and you look at the operating cash flow formula, sales minus cost, right? That sounds a lot like sort of gross profit, right? You know, so you take the sales minus cost, multiply that times 1 plus the tax rate, or 1 minus the tax rate. That's how much you would keep after taxes from that. Okay. But we're going to add back the tax portion of depreciation, right? So if you see like that 0.21, that's the tax rate times the amount that we depreciated off. Why do we add that back in? Because we don't actually pay for depreciation, right? It's an accounting thing for bookkeeping, So we write down the value of the asset and we write this depreciation there. Okay, but we didn't actually pay any cash for depreciation. So when we're looking at operational cash flow, we need to add that back in, right? And so it's that tax rate times the depreciation, because that depreciation sheltered some money from taxes. So that's why we don't just add depreciation, we're putting that tax portion back. Sometimes you'll see we just add depreciation, but the whole thing is going to end up getting multiplied by tax. And so that's why it works out. But like I said, algebraically, there's like 4 different methods that they show. But they're all actually the same thing when you pull all the parts out. But yeah, so and this is operational cash flow again. We like to do this for a project because we're focused on just what did this project do, not what was a cool tax thing that also occurred, right? We shouldn't be doing business decisions because of this tax or that tax. We should be doing it because it's a good business decision and we should fully take advantage of all the taxes, right? Is that, hopefully that makes sense. Okay, this problem is really just to sort of get your mind set, because we're going to do some NPV calculations using sort of best case, worst case scenarios. But the way to think of this is they make estimates. What, you know, the marketing folks will come back and they'll say, we think we're going to sell this many units. We think we're going to sell them for this much. We think it's going to end up costing us this much to make them. And we think this is going to be the cost of our factory, right? And then they're going to say, oh, but you know, plus or minus some percentage, right? And then so when you're thinking of best and worst for sales, is it better or worse to sell? You know, do I want to sell more or sell fewer? You know, I want to sell more, so best case will be bigger, worst case is smaller. Prices, do I want to sell it for more money or for less money? I want to sell it for more money, right? So best case is higher, worst case is worse. What about cost? Well, best case, my costs are lower. Worst case, my costs are higher, right? So best case is low, worst case high. And then, you know, it's variable costs or fixed costs, right? I always want my cost to be as low as possible. And I want my, the prices that I receive and the units that I sell, I want those to always be the highest that they can possibly be, right? So hopefully that all makes sense. We're going to work through a problem that we do this. Okay. So here's a case. We're going to have to calculate what the operational cash flow is going to be. And we're looking at best case and worst case scenario, right, for all of these. The tax rate is 24%. That's the same, right? We're not changing. We're not assuming, you know, we get a new government and taxes go up, or we get a new government and taxes go down. You know, that's not changing. And then the rate of return, that's fixed also. So that is not changing. So that rate of return of 9% is going to change, or is not going to change. Sorry. But yeah, and so when we're calculating, you know, these operating cash flow, right? It's the same thing that we did before, right? We have this thing 1.8 million that was depreciated over 6 years. And then we have the cost and our price, right, that we can you know, account for. And then everything is within 10%. So some of those you inflate by 10%, some of those you deflate by 10%, right? So best case, all your sales are higher and all your costs are lower. And then in the worst case, all your sales are lower and all your costs are higher, right? If you wanted to put this into the calculator, as we did before with the cash flow, then what you would do is for cash flow 0, it will be the negative $1.8 million, right? And then for your C01, it's the 248.68, right? Like take that best one. And then you could do that, have F1 and then put it in for every year, or you could just let's see, put in put that in, and then for F01 you can just put 6, right? And it'll say, okay, I'm doing this for 6 years in a row, that frequency 6, right? And then for the worst case, you'll just have the lesser amount that you're putting in, and then calculate what that net present value is, right? Now, obviously, once you calculate that your operating cash flow is negative, you know your net present value is going to be negative also. Um, but yeah, that operational cash flow, if it's negative, you're probably doing something wrong, right? I mean, that's a really bad sign because you're not selling enough units to cover your fixed costs, or you don't have a high enough price given your costs on the variable side. But there's an issue there, if your operational cash flow is negative. Um, okay. And then as far as calculating sensitivity, this is like, how much do I care that you're wrong? So you tell me we're going to get 1,000 units sold and we only get 800. How big of a deal is that 200 that we missed by, right? And so in this particular case, we're just going to calculate operational cash flow at two different production levels, 82,000, 83,000 units, right? You get what that change in operational cash flow is divided by the 1,000 units, and it's $8.34. So for every additional unit sold, we make $8.34, right? Now, if you look at the unit price, you'd say $38.99 minus $28 and a penny. Shouldn't that be like $10.98? And it's like, well, it would be, but we have to cover all of our fixed costs. We have to pay our taxes. We have this depreciation piece, so there's just a lot more going on. So it's not as simple as price minus that cost, but instead, once we've accounted for all of these different costs, what is that total change per unit? So again, this is just a way of us seeing how sensitive we are to sales, because that can help someone make a decision. Yes, let's do this, or no, let's don't. Okay. And this one, just to have a fun closeout, right? There's a lot going on, I know, with this problem too, but we're gonna kind of go through it, and you'll see that it's easy enough to do this with the calculator. So they tell us we've got two current sets of clubs, right? We've got expensive clubs and cheap clubs. And then we've done a lot of research to see about adding a new set of clubs, right? And it's going to be between our cheap set and our premium set. And we're hoping this will be our new sort of entry club. Okay. And they tell us all kinds of different costs. And they tell us how introducing these clubs, right, we're going to cannibalize some of the sales of the more expensive. Somebody was going to show up and pay over $1,000. They see this brand new set of clubs under 1,000. They'll just buy those, right? There'll also be people that see all this advertising and they come in and they're like, yeah, I'm going to buy some of those new clubs. They see that price and they're like, well, there's a cheap set right over there for less than 400. Maybe I should get those, right? So some of these we're going to have additional sales on. Some of them we're going to lower our sales on, but they're all going to have their own price point. They're all going to be able to therefore generate what that payout's going to be, right? Each year. So you see what those sales numbers are, and then for our variable costs, right, we have the change in sales. So the new clubs are brand new, so they're going to increase by 89,000, right? The expensive clubs, we don't have to make as many, so it's 9,050 fewer, but we have to make more cheap clubs. That's 11,700, right? So we get what the total variable costs are. So we have our change in sales. This is our change in variable costs. As far as the fixed costs, we are ignoring all of that sunk cost that we had to begin with, but we do have to pay 53 million for all that initial equipment, and then we're going to have another 4 million plus of working capital, but that 4 million we'll get back later. So you add those together, that'll give you that initial payment that you have to do. So hopefully that part makes sense. I'm going to go to another slide. Okay. So we have the sales, right, of all that stuff we generated. Then we're going to subtract off the variable cost. Then we have that payment, that fixed amount that we had to do. And then we're going to have depreciation, right? Because we're going to just do a straight line depreciation on those. What is left is earnings before interest and taxes. We're ignoring interest because this is only looking at the operational side, not financing, right? But we do still have to pay taxes. And so we get our net income of almost 12 million, 11 million, 750,000. Okay. So you take that, but we have to add back that depreciation, right? So adding back the depreciation piece, that operational cash flow was going to be 19 million, 413,000. Okay. So that is how much we're going to receive every year, except the last year, right? And I'll explain why in just a second. Okay. So to go back, the first part said, hey, what's the payback period? So how long does it take us to get that 53 million back, right? The first 2 years, right, aren't quite enough. We're left with 18,847,000 for that third year, divided by the 19 million we're going to make in the third year. We get a total payback period of 2.97 years. Okay. Now, how to put this in the calculator for NPV and IRR. For that cash flow, we're going to put the 57 million, right? Why 57 million? Because it is that working capital piece as well. We're gonna have to go ahead and pull out that extra, 4.5 million. Okay. Now we get the operating cash flow, and I said it's going to be the same except for the last year. So in years 1 through 6, right? We get that amount, and then for the 7th year, I get that working capital back, that 4 million and some change back, right? So that's why I have the cash flow 1 and the frequency of 6, and then that second cash flow and a frequency of 1. Okay. The problem said to use 12%, so that's going to be your I, and then you'll calculate NPV and IRR. IRR is higher than our required rate of return. 28 is bigger than 12, right? So we know that's good. And we also know we're going to have this positive NPV. Okay. So I hope that helps. If you do have any questions as you're doing this module, please do let me know. I do want to help you. So thank you so much.